Welcome to Prime Perspectives, where Keith Galicia guides you to the financial finish line. As a certified financial planner practitioner, he covers all topics in financial planning. Join him each episode to gain insights and strategies, helping you pursue your financial goals together.
Welcome, everyone, to the Prime Perspective podcast, where our goal is to get you to the financial finish line, whether it's anything from retirement planning, estate planning, risk management strategies, or perhaps even you're a business owner and looking for ways to find efficient ways to exit your business as well. But today is more focused on investment strategies and ways that certain companies look at the next line of companies that we're looking forward to. So today, we have a very special guest. His name is Ryan Hodapp. Ryan, thanks for showing up today.
Hey, thanks for having me, Keith.
Absolutely. And today we're going to talk about innovation and perhaps some of the companies that we're looking for in the future. So today, Ryan, let's just get right into it. Can you tell me and the audience a little bit about your background and how you got into the financial services industry?
Sure. My path into the business, as we call it, was fairly traditional. I got an undergrad degree in finance from St. Louis University. And in my last 2 years of undergrad, I had an internship in the managed products department of what used to be A.G. Edwards. So A.G. Edwards home office. In the early stages of my internship, I was doing typical intern things like stuffing envelopes and making copies. But at the tail end, I actually got a chance to work with their mutual fund research team, helping them update performance numbers and stuff like that. And fortunately, right out of undergrad, that team actually hired me on full time. And it was a great job to start into the business because I was getting to talk to actual portfolio managers, some of the best investment minds in the world at a very young age. So it was a really great job to learn early on in the business.
Was there anything that drove you to financial services? Was it something you'd always aspired to through college, or what really inspired you to pursue that career?
That's a really interesting question because I was thinking back to like when I was a little kid. I always thought I wanted to do something with animals, like zoologist or veterinarian. And I don't know what it was, somewhere along the lines of high school, college. I think I became interested in the very simple concept of how do I take a pool of money and grow it into a larger pool of money, right? Which is investing at its very basic heart. But I think what did ultimately evolve as I grew into the business from young Ryan was the simple fact that risk is joined at the hip with return, which is the growth part of the story. And I became more and more interested in, I think, asset allocation, diversification, sort of thinking about how the pieces of the puzzle fit together. So it kind of started with return, then realizing it's not a one-way story.
So you mentioned research. Are there specific areas that you specialize in?
Great question. For context, and I'll kind of take you through my current role, my current company. I work for a company called Resolute Investment Managers, and Resolute runs sort of a multi-affiliate business model where they either have investments or ownership stakes in investment boutiques that need help with distribution, or outright distribution relationships with some of these boutiques. In this instance, one of our notable distribution relationships is with a firm called ARK Invest. And ARK was founded by Kathy Wood about 10 years ago. Sole reason for being is to identify, research, and ultimately invest in disruptive innovations. I myself am an ARK Invest product specialist for Resolute. So I'm one of the ARK kind of subject matter experts. And there's a couple notable aspects to my current role. Number one, I spend a lot of time talking to advisors and investors just about what ARK is doing, how they manage money, what innovations they're thinking about investing in, their macro thoughts, et cetera. Secondly, we have this presentation deck I often use called Big Ideas. In the Big Ideas presentation, we talk about the long-term opportunity that ARK is seeing in the various innovations they're researching and how they're going to change how we work, live, and play. I often give that presentation at client and advisor events as well. So there's sort of a public speaking aspect as well.
I was lucky at our latest conference. I went to one of the breakouts there, and most breakouts are pretty average. But I went into that Big Ideas and I left way mind blown, right? With it was great. And so let's get into under the hood of maybe some of that conversation that I was able to listen to. You mentioned disruptive innovation. How does ARK define disruptive innovation? And what criteria do they use to identify?
Sure. As I think about just disruptive innovation as a concept. Think about it as a technology and innovation, a business that is essentially taking market share from a legacy business or technology, or you're seeing some sort of directional spending patterns that's eroding the legacy business. One of the things that sort of helps us get there is something called Wright's Law. And what Wright's Law says is for every cumulative doubling in units produced over time, so you go from 2 to 4, 4 to 8, 8 to 16, when we see this sort of cumulative doubling in units produced over time, you eventually get a very powerful tipping point for unit demand and growth, which helps drive adoption. Adoption really accelerates because things get cheaper. And as we look at across some of these disruptive innovations, everything from DNA sequencing to AI training to the batteries that go into electric vehicles, they're all kind of following this Wright's Law cost curve. And eventually, again, there's that powerful hockey stick for unit demand and growth. And that's where you start to see that accelerating adoption. And then we're, of course, along the way monitoring for, are we seeing directional changes in market share change?
So what sectors or industries do you believe are currently experiencing those most significant disruptions?
Sure. It's hard not to talk about artificial intelligence because I know that's been the topic of the town. But what I think about, what I think is interesting about AI in the context of the question that is sector specific, what's interesting and unique about AI is it's touching so many different sectors and industries all at the same time. AI is improving the analytics of DNA sequencers. It's helping improve the performance of robotics. It's helping power autonomous vehicles. There's 3 completely different businesses off the top of my head, and it's impacting all of those in profound ways. So I think AI is really interesting in just how many different types of sectors it's actually impacting. Getting a little bit more specific, if we go specifically like to the healthcare or life sciences space, I think one of the most exciting innovations is what's called CRISPR-Cas9 gene editing therapies. I'm not a geneticist, but I occasionally play one on TV. So the way to think about CRISPR is you send an enzyme to a very specific spot on your genome where something is broken. It clamps on and acts like a literal DNA scissors. It cuts out the bad stuff and brings in a bridge to right the ship. What's so exciting about that particular space is, these companies are literally creating what could be functional cures. And late last year, we got some exciting news in that we had the first in history FDA approval for a CRISPR treatment. And this is a permanent change in your genome. Specifically, we got FDA approval for a CRISPR treatment for sickle cell disease or sickle cell anemia. People who unfortunately have that disease sometimes have to go in the hospital 17, 18 times a year on an emergency basis for blood transfusions. We've heard instances where some patients with one single CRISPR dose have gone something like 4 years without a single blood transfusion. So completely life altering. I actually listened to a podcast a handful of weeks ago, and the podcast host interviewed the 4th person to receive the CRISPR dose. It was a gentleman from Nigeria who came to the US. And on the podcast, he talked about when he had sickle cell, sometimes the pain was so bad he would pass out. He had all kinds of breathing issues. Now, post the CRISPR treatment, he is getting ready to go on an expedition to Mount Kilimanjaro. So again, completely life-changing. So I think that's one of the big ones. And then the other one, which I imagine we may talk about in greater depth later, would be autonomous vehicles, because that's certainly going to have some profound impacts on the economy and society at large.
Absolutely. I've told that story actually about CRISPR once I was able to leave that breakout, because I just thought that was amazing. And you don't really understand what some of these bioscience companies are doing and how they can certainly benefit. Everybody thinks about disruptive innovation as AI or autonomous vehicles, but it can be across the board with all sectors. And it's kind of one of those things that if you're not working on continuously ongoing improvement, you're certainly get left behind, which leads me to my next question. How does ARK assess the potential impact of disruptive technologies on established industries that have been around for maybe 100 years or anything like that?
Sure. I'm going to build on kind of the Wright's Law story, because I think that also helps answer that question. Because again, the impact on those established industries getting disrupted is that definition of disruptive innovation. So anyway, I talked about Wright's Law. We're looking at these cost curves. You eventually get that powerful hockey stick for demand. The question is, what do you do with that data? Well, one of the things behind that ARK is often seeking out is what they call TAM, or total addressable market. In other words, how big could this market opportunity be? And so I'll give you a real world example to help bring it to light. Think about the electric vehicle business. Applying Wright's Law, far and away one of the biggest cost components to make an EV is the battery. makes up, I think, like 25 to 30+% of the cost structure to make an EV. Based on Wright's law, for every cumulative doubling in units produced over time, we're seeing a 28% reduction in the cost of the battery that goes into EVs. And what that's led to practically is EVs are now essentially at price parity with their gas powered equivalents. So that is the legacy business, right? That is the legacy industry. But it's not like Wright's law stops. We're going to continue to roll down that Wright's law cost curve and get to that powerful hockey stick for unit demand and growth. And ARK thinks that if you think about the total addressable market, as that curve takes off, we could see upwards of 70 to 75 million electric vehicles on the market here in the next 5 years. So what's the sense for what that total addressable market could look like? You can both compare and contrast that to what you think might happen with the legacy industry. And by the way, you're also going to be looking at those baby steps along the way. Is this business gaining traction from a market share perspective, from an adoption curve perspective? And sure enough, with electric vehicles, we are literally seeing EVs take market share at the expense of those legacy gas powered vehicles. This is applying to a number of different businesses. It either is or will. Like one we expect to happen, for example, is that autonomous trucks could eventually supplant the rail business. So there's an example of one of the legacy businesses that's at risk. And then digital wallets could prove disruptive to large banks of all things. So again, to your point, it's happening across so many different sectors and industries.
Absolutely. When we think about disruptive innovation, disruptive technologies, right now the conversation is AI. Sometimes you hear, hey, is there going to be some kind of bubble, like maybe what we saw with the .com era? How do you evaluate long-term scalability and market adoption of some of these new technologies?
Sure. Scalability and market adoption. One of the other things that ARK also looks at is called S-curves. So an S-curve is basically an adoption curve. Literally an S shape where early on there's some sort of new product or service and the adoption is a little bit slow out of the gates because everyone's trying to figure out what's going on. Then you eventually have the early adopters where you start to see a little bit of an acceleration. And then eventually everyone kind of piles in later stage. And then eventually there's a leveling off as that business matures. So first of all, we're trying to think about what does that adoption curve look like across that S curve? Where's the company in that particular cycle? The other thing that they spend a lot of time thinking about is what they call convergences. And by convergence, we mean two or more technologies that are sort of feeding into each other. So earlier, I gave the example of AI is now feeding into sequencers and it's helping improve the analytics of sequencers. It's also helping drugs come to market quicker because what you now can do is when you're doing your drug trials, you can target people that have very specific biomarkers to make sure you have the right people in your drug trial in the first place. That's going to lessen failure rates and that's what's going to help drugs come to market quicker. But again, that's two very different technologies sort of feeding into each other. What happens coming back to S curves is when you have that convergence take hold, you have S curves feeding into other S curves, and that can both drive an accelerated adoption. It can lead to what we call exponential growth, and that can also really expand the scalability. And then also thinking about things that happened like in the early 90s, late 90s, we had the tech wreck, right? And in the tech boom, there were a lot of technologies that I think there were some really interesting ideas. Even early 2000s, 2003, we had the original Human Genome Project in the healthcare space. But what was interesting about that time period was that there were a lot of interesting seeds planted, but a lot of the technologies either weren't ready for prime time or getting back to Wright's law. Some of these technologies were just too expensive. It cost $2.7 billion to map the human genome. Now you can do it for a couple $100. So it gets back to, we want to make sure that these technologies aren't too early in their life cycle, but they're just not so expensive that it's not going to drive adoption and lead to scale.
Sure. No, I dig that as well. So let's talk a little bit more about strategy as well. Talking to the individual investor that might be listening to this conversation today, it seems like everybody's an expert, whether you go on TikTok, whether you go on YouTube, or whatever social media venue you decide to use. What advice would you give to individual investors interested in gaining exposure to disruptive innovation?
Sure. To your direct comment where you said everyone thinks they're an expert, I would say if you do have clients and investors that are seeking out an investment in true disruptive innovation, ask them what their domain expertise is. And what I mean by that is, and this is very specific to ARK, one of the things that's pretty unique about ARK is when they hire analysts into the firm, they typically hire people that come either directly from the industry that they cover or people that come from academia. For example, we have one analyst that was a tech consultant and a software engineer, and he worked on big projects for some of the major social media companies. We had another analyst that spent 10 years at MIT doing genomics research and had a number of his publications cited hundreds of times. Kathy Wood, the founder of ARK, always says she wants her analysts to make sure that they have one foot in the industry that they cover. Because particularly when you get into areas like CRISPR, for example, it's a really different ballgame when you get into the science. And sometimes your typical investment finance analyst won't necessarily understand the science and technology. So seek out that domain expertise, number one. Number two, almost the opposite side of the question is maybe what to avoid. There are a lot of growth funds and tech funds that all own the same kind of usual suspects, right? There's 5 to 7 very large technology companies that most people own. And we may have some exposure to that, but usually not in size. Be mindful of that kind of sameness. We're looking for companies that are kind of earlier in their cycle that are the disruptors. Sometimes those really big, large technology companies could be the very ones that actually get disrupted. And then last but not least, as I think about investing in disruptive innovation through a true investing lens, disruptive innovation is inherently volatile because sometimes this is the closest you can get to venture capital while still being in the public markets. So you do want to be mindful of your position sizing inside of an overall diversified portfolio.
Right. Asset allocation is important, right? I mean, you definitely don't want to have all your eggs in one basket.
Correct.
And it's nice to have some exposure in this disruptive innovation category, but don't think you're going to just ride it to the moon. It definitely has some peaks and valleys for sure. Well, let's look at disruptive innovation and technologies underneath with specific sectors. And this is one thing that most people don't think about. So I'd like to see your opinion on this. With which disruptive technologies are most likely to have a profound impact on the financial services industry?
Oh, sure. Yeah. Financial services. In our parlance, we often call it fintech or financial technology. I teased probably one of the biggest ones earlier, and it is what's called digital wallets. So think of a digital wallet as a bank branch that you can essentially access on your cell phone. A lot of these digital wallet companies gained popularity early on through what's called a peer-to-peer payment system, where you can easily send money to your friends and family, phone to phone. One of the interesting trends that has started to take hold behind that within this digital wallet space is a concept called a closed loop transaction. So if you think of your typical e-commerce transaction, you're buying something on a website. What you typically don't see is there's usually a bank and or transaction processor that's taking a 2.5% scrape of that transaction. Well, what a closed loop transaction is imagine if you already have some money or cash in your digital wallet, and these digital wallet companies have favored nation status with very specific retailers. If you do business directly between the two, what you can do is you can completely remove that middleman. That could be very disruptive for those banks and transaction processors that are used to getting that 2.5% scrape. So I'd say that's number one. Number two, just speaking of e-commerce, because they are also trying to think about commerce and payment rails and stuff like that. One of the other concepts that they've been doing a lot of research on is what we call social commerce. So it's sort of the marrying of both social media and e-commerce. If you've ever been on a major social media site, a lot of them now have a shopping tab at the bottom. And I think when that first started to happen, it was always a little sketchy when you were buying something from someone on those social media sites. There are now companies that have helped better legitimize those transactions. And what we are seeing is social commerce is now taking market share at the expense of legacy e-commerce. I would also throw kind of digital assets and crypto as a disruptor in fintech as well.
Sure. You're actually reading my mind because we are going to get to that shortly. But let's talk about probably the most everyday conversation. You see podcasts about it left and right. How do you see AI, artificial intelligence, and machine learning evolving next decade?
Yeah, it's a difficult question to answer because it's a very big question. And we think artificial intelligence is the biggest of the big ideas, I like to say. So let me give you a sense, first of all, just how ARK is thinking about AI philosophically and ultimately what's going to lead to some of these big, profound changes and the impact that AI is going to have in general. First of all, coming back to cost declines, this is an area where we're seeing very rapid cost declines. So there are some popular chatbots out there now. There's one called ChatGPT. And what you can do is with a very simple text prompt, you type in a text prompt and you'll immediately get some sort of output. Well, there is a large language model or foundational model behind ChatGPT. There is a cost associated with feeding that model tons and tons of data, both on the hardware and software side of things. That's what's called AI training cost. those AI training costs are falling at a rate of 75% per year. When you fall down a cost curve that dramatically, it just helps democratize the technology and allow more businesses and industries to use it. It's one of the reasons I think every company under the sun right now is talking about what should my AI strategy be? Partially the reason they're doing it is it's just become more cost effective. So that's number one. And then number two, we just think AI is going to be a huge productivity enhancer throughout the rest of the decade. We think AI may lift the productivity of what we call knowledge workers. So think everything from paralegals to software developers. We could see their productivity go up by 4.5 to 5x due to artificial intelligence. And then look, we've already talked, there's going to be so many interesting convergences going on. We talked about the sequencing impact, autonomous vehicles, but robotics is an interesting one to think about. If you go onto your favorite e-commerce site right now and you buy something, if you haven't noticed, from the time you click buy to the time that little brown box shows up on your front door, that time is compressed dramatically. And that has everything to do with the AI behind the robots just getting better and better at literally just placing things in boxes. It gets better and better through repetition. And then last but not least, the other thing I think we're thinking about with AI is we're eventually going to see guidelines around safety, right? That is going to happen as well. We just don't entirely know what that's going to look like yet, who's going to be responsible for that. But as we think about that forthcoming topic, what we're hopeful happens is that we do have some sort of safety guidelines, but it's not so overregulated that we stifle innovation. So that's another thing that we're going to keep an eye on here over the next several years.
Sure. I mean, you hear Elon or Lex Fridman talking about their concern about AI is just as progressive it gets. It seems just like it exponentially gets smarter by the minute. And so that would certainly be a touchy fence to dance on, because you want to encourage innovation, but then you want to make sure that it's handled in a manner that can be somewhat managed as well without creating severe damage. So we're still on the topics of individual sectors, and we know blockchain is certainly a conversation as well. What are ARK's thoughts on the future of blockchain and its potential beyond cryptocurrencies?
Beyond cryptocurrencies. Okay. So as ARK is thinking about the overall crypto and what we call digital asset space, there are three, they call it concurrent revolutions going on all at the same time. There's first of all, what we call a money revolution, and that has everything to do with Bitcoin. So that does get a little bit more into the cryptocurrency of it all. And we do like Bitcoin long-term just because there are some really interesting supply and demand dynamics. But looking beyond the money revolution, the other two revolutions are a financial revolution, or what we call DeFi, decentralized finance. And then the third revolution is an internet revolution, or what we call Web3. So as we look at DeFi, one of the underlying technologies powered by that is what's called a smart contract. And a smart contract is a code that kind of sits on top of the blockchain. And think of a smart contract as a simple if-then statement. If I post a certain amount of capital, automatically execute Y. Getting back to potential disruption, that in theory could be very disruptive if it was applied to the mortgage business, for example. I mean, think about just how difficult the mortgage process is when you buy a new home. Tons and tons of paperwork. You got to sign your name 100 times, lots of middlemen. What if you could just automatically post, let's say the number is 20% of the value of the mortgage. You post the collateral, boom, auto execute Y, you're done. That could be very disruptive to a lot of those middlemen that are used to getting involved in that robust mortgage process. And then that smart contract capability also is going to help kind of accelerate settlement times, because instead of having to wait 1 day, 3 days, whatever, it's almost instantaneous. So that could prove disruptive as well. And then in the kind of internet and Web3 side of things, that gets more into what we call verifiable ownership of digital assets. A few short years ago, NFTs or non-fungible tokens was kind of all the rage. People were paying millions of dollars for Twitter profile pics, and there was certainly a lot of froth in that particular space. Behind that, I think what's come out of that is verifiable ownership of digital assets, but more in kind of digital world like video games. So you can, on the blockchain, actually have verifiable ownership of a character in a game, or maybe a football player or something along those lines. The video game company might say this is a 1 of 1 or 1 in 1,000, and you'll have a long alphanumeric string on the blockchain that proves that you actually own that 1 of 1 or 1 of 1,000. And then even in the music industry, smart contracts actually could apply there as well, where maybe you set up some sort of smart contract that automatically delineates what money goes to the artist versus the record label. Or maybe you could even remove the record label altogether. So there's some interesting implications outside of financial services that actually may impact gaming and the arts.
Okay. Yeah, no. And the reason why I brought that part up first is because people think that blockchain and crypto is synonymous and they don't realize that it can go other tangents. Let's keep going on individual sectors here. And you've touched on this earlier in the conversation, but when I go to LA or whenever I go to a big city, you'll see these autonomous vehicles with 15 different sensors on it. Looks like a big scuba snorkel on the top of it. And it's just kind of driving around town as a taxi. Can you discuss the potential impact of autonomous vehicles on the economy and society?
Sure. I actually saw one of those in LA just a couple weeks ago. Yeah. So first of all, I think the societal impact that people are vastly underestimating is it is going to be safer. People have a really difficult time getting their arms around it because this is literally a fully autonomous robotaxi with no human driver. The reason I say it's going to be safer is we as humans are more distracted than we've ever been when we drive because of our cell phones, right? We've got our cell phone sitting in front of us. We got tweets and texts and all those kind of things coming at us. And because of that, driving has gotten more dangerous. I think something like 85% of accidents are due to human error. Well, a fully autonomous robotaxi powered by deep learning artificial intelligence is not going to be distracted by your cell phone. So I think that's going to be a great, great societal impact. And then on the economic side of things, this technology could create a profound level of economic growth that we probably haven't seen for some time. If you think about your typical commute, I think the average American commute is something like 45 minutes plus or minus, and that's both ways. Well, when you're commuting to work, that is idle time. You're usually not doing anything productive because you got to pay attention to the road. Well, imagine if instead you're sitting in the back of the car, you don't have to pay attention to the road. You could be doing something productive. You could be working, or you could be watching a show on your favorite streaming. Whatever the case may be, we will all of a sudden be creating economic activity that literally never existed before. So that could prove constructive to overall GDP growth on a global basis.
Sure, absolutely. Well, my last question when it comes to sectors is about renewable energy. And everywhere I drive, I see these solar farms now. And I know that's just one of the facets of renewable energy. And so how does ARK view the role of renewable energy in driving disruptive change across various industries?
Sure. Led off with electric vehicles earlier, because that's certainly kind of a fast growing area. Electrification or just these battery packs in general, it's not just going to apply to the automotive industry. So we're going to see electrification in autonomous trucks to be used for shipping, for rolling drones, for flying drones, and even for what we call electric vehicle takeoff and landing, eVTOL. So imagine your Jetsons air taxi. That is all forthcoming. All those technologies are likely to be powered by electrification and battery pack systems. Second, one of the other interesting things that we've noticed is there are some large integrated oil companies that are actually capturing the natural gas flares that they would normally flare off into our atmosphere. Not exactly a clean technology. They're actually capturing those natural gas flares and recycling that to power Bitcoin mining of all things, which I think is really interesting. Thirdly, I often get asked when I talk about electric vehicles, isn't that going to have a damaging impact on the grid or something along those lines? The bigger question behind that is actually what happens with artificial intelligence. As AI proliferates, you're going to see more and more money spent on these data centers that are actually behind the scenes powering AI. And those are going to consume a fair amount of electricity and energy as well. One of the things that we think may help alleviate some of that kind of demand on the grid, and this is a clean power source, would actually be nuclear. And then last but not least, there are companies that have been building, and this is starting to grow pretty quickly, actually energy storage businesses. So imagine just a very large energy storage farm off-site as there's a big run on the grid in California, Texas, wherever it may be. These energy storage sites are designed to take on that excess demand when it's really running hot and dial things up and down as needed. So that's another interesting kind of clean technology, or it's going to help, I think, if nothing else, kind of augment that demand on the grid that we're going to see both from EVs, but more importantly, AI data centers.
I don't know if you've just been reading my mind, but as you're talking, I'm always looking for follow-up questions here and you just answer them. You've been super thorough on all of that. Well, let's finish up this podcast with a couple of questions. I always like to finish up something with maybe the outlook and how we see this innovation moving forward. what do you believe are going to be some of the biggest challenges and opportunities for disruptive innovation next 5 to 10 years?
Okay, so challenges and opportunities. A few challenges looming out there. One of which I guess I already touched on to a degree, but regulation is always a challenge or risk, whatever the case may be. But it's going to come in a lot of different forms. Even if you think about like the potential impact on those kind of large usual tech suspects that I mentioned earlier, one of the risks there could be antitrust risk. But what I would say, as we look at disruptive innovation broadly, we want appropriate regulation, right? That's what's needed to make our economy run. But as I mentioned earlier, we just don't want it to be so onerous that it stifles innovation here in the United States. So that's something we're always keeping an eye out for, kind of that regulatory balance. The second, challenge or risk, for lack of a better word, is what we call long duration risk. So we are investing in companies that are long duration in the true sense of the word. And what I mean by that is we're investing in companies that are often investing heavily in research and development in the here and now for strong cash flows and profitability in those further out years. And what that means practically is sometimes they can be more susceptible to interest rate move, particularly when there's really swift upward movements in interest rates, or there's sort of a higher for longer scenario. We are a little bit more interest rates sensitive. Now, hopefully where we are in the cycle now, we're getting ready to see interest rates come down. So those headwinds can become a tailwind as well. And then the final kind of challenge or risk out there is actually acquisition risk of all things. And it's one of those sort of good problems to have. If you, for example, believe that in the genomic space that our valuations are so compressed right now that they eventually become acquisition targets, the good problem to have is if those companies were to get acquired, you get a nice, often 20 to 30% pop in one day. That's the good problem to have. The challenge or risk is we think a lot of those companies can actually grow beyond that as we look out over the next 5 years. So it's more of an opportunity cost risk, if nothing else. And then the opportunities, I'll just leave you with one. We think most investors are just underexposed to truly differentiated, true disruptive innovation. And we think if we can get it into client portfolios, it's going to solve a couple issues. I mean, number one, hopefully they're going to participate in the potential growth of these disruptors. But secondly, if nothing else, if you put a small sliver of innovation, disruptive innovation in your portfolio, it can be a hedge against the potentiality of other businesses in your portfolio actually getting disrupted. So you can both participate in the growth and have kind of a built-in hedge against being disrupted. So we just think a lot of people are underexposed to true disruptive innovation.
And how do you, that's a lot to unpack. And we've certainly touched certain companies left and right that are talking about all of these things. And there's multiple in each sector. And what does ARK plan? How do they plan to adapt its strategy with this rapid pace of technology advancement as it's going to continue to accelerate?
Right. It's moving so quickly. I mean, ARK would even tell you those like AI training costs that I mentioned, they're falling even faster than they would have expected. I think the simple answer is you need to be active in this space. Like I personally would not want a passive strategy because to your point, it moves so quickly. If you are in a passive static strategy, you're not going to be able to adapt to those changes when they happen. And ARK themselves, they have a very robust process that is designed to be long-term in nature. If things change, we very much will change within that 5-year window. And to sort of help bridge that gap, as but one example, let's say there's a company that we really like looking out over the next 5 years. But let's say that company has a short-term quarterly earnings miss. Maybe they miss earnings by a penny. A lot of times what happens then is the street flushes that stock out. It goes down 10, 15% in a day because there's that sort of overreaction. In a company like that, if we truly believe in the long-term story, we're often going in and adding on that weakness. So that's an example, just even in day-to-day active management of being short-term active in the context of a truly long-term view.
Oh, absolutely. Well, Brian, I think I picked the right person to address all of these topics today. I mean, you have been able to absolutely just kill it and make it make sense to somebody that is just thinking about the high levels of autonomous vehicles, renewable energy, or anything that we've talked about today. Certainly appreciate your time on this. Folks, if you'd like to learn more about disruptive innovation and how we could complement your portfolios with anything that we've talked about today, please reach out to me, Keith Galicia, primeportfolioplanning.com. Feel free to reach me on all of our socials. I certainly partner with Ryan. So any information that we need on that is obviously able to provide that for us. And even that big ideas presentation, there is a lot there and a lot of really cool stuff that's available. So Ryan, thanks again for your time. And folks, stay tuned for another episode of the Prime Perspective.
Thanks so much for having me.
Keith Galicia is a registered representative with and securities and advisory services offered through LPL Financial, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Ryan Hodapp is not affiliated with or endorsed by Prime Portfolio Planning and LPL Financial.